Hello, my name is Sean Novak, and I am the president of Longevity. Wanted to thank you for looking at the option of purchasing or refinancing your home with us. This video is to go over a loan estimate disclosure. Loan estimate disclosure is an important part when you're shopping around for a mortgage and is the best way to truly compare apples to apples with different lenders. A lot of loan officers or lenders can tell you a lot of things over the phone and promise you a lot of stuff, and then everything is a little bit different in writing. So you got to make sure you review it thoroughly to make sure you're getting what was told to you. For example, a lot of times people promise you, oh, nothing is going to be out of pocket with this loan, and then all these fees and points get rolled into the loan without you even noticing. So we'll go over it briefly to see how we can compare and what to look for, and I hope this finds you well. So again, you can see here in front of you is the loan estimate disclosure. It's a standard 3-page document that has 3 parts to it. The first part, you can see the name of the company on the top left corner, the address, and then right below that it shows a loan estimate. Now this is an official format, so it cannot be different from any lender to another. This is what was approved by the government and required by the mortgage bureaus to use when disclosing a new offer, because this is actually obligates the lender to this offer as soon as it's locked. So first, you can see the date that the loan estimate has been issued. Below that, you'll have the name of the borrowers and also the current address that they live in or mailing address. And then below that, you'll have the actual property, the subject property in question here is the address, because if it's an investment property, it can be a different address than your primary address. Then below that, you're going to see property value. Property value is very important because loan to value ratios can affect your pricing. For example, 60% loan to value and a 70% loan to value can have 2 different pricing offers to them. So sometimes you have agents that overpromise and put in a bloated value to show you a really competitive rate, and then have the appraisal come back at a lower value, and then tell you, oh, sorry, but the rates are now different because of that value. So very important that you being conservative up front. Also, a lot of times you can get the waiver, basically an appraisal waiver, so where you will not need an appraisal, but still a good item to look out for. To calculate the loan to value, you take the loan amount, 346,000 in this example, and you divide it into the actual value stated here, and you can see here this is a 60% loan to value ratio. On the right side, you'll see the term of the loan. Here, this example, it's 20 years. Below that, the type of transaction, the purpose of it, refinance or cash out or purchase. And then below that, it's telling you if it's a fixed rate or an adjustable rate, and the type of the loan, which is a conventional FHA or VA or anything else. FHA and VA loans are government products. And also below that, it shows you if the rate is locked. So that's another item to look forward to. A lot of times you can get this disclosed and the rate has never been locked, and there's keep floating your rate to maybe hit a lower pricing or whatnot. So make sure after you electronically sign your documents that you have a locked loan estimate where it says yes next to the rate lock. Below this is the first section where it tells you the loan terms, where you're going to have the loan amount, the interest rate, the monthly principal and interest payments. On the right side, you can see that none of these can change after we close the loan, showing you that it's a fixed product. Then right below that, you'll see a prepayment penalty and a balloon payment option where most loans out there these days do not have any prepayment penalties, meaning you can pay off the loan earlier, sell the house, pay it quicker without any payment penalties whatsoever. And balloon payments is basically where you have a balloon payment at the end of the loan, which again is very unusual in this market. Then in the middle of the page, you'll find what your payments will look like if you pay taxes and insurance, including with that payment. So you'll have a breakdown, principal and interest, mortgage insurance. If the loan to value is above 80%, you may have this. An estimated escrow payment. That could change. We estimate it as close as possible up front, but that may change once we go into processing to adjust it according to what the taxes and actual insurance, homeowners insurance are, and then it will total it up for you with your principal and interest payments on the bottom. Then you'll have another figure of the estimated taxes and insurance and some other assessments. So you could have an HOA, homeowners association fees in here as well. This is not the same as your escrow payment, but it just shows you what your total payment aside from your principal and interest payments, and it tells you if it's in escrow or it is not. All right. Then on the bottom of the page, you'll have costs at closing, estimated closing costs, and estimated cash to close. The closing cost gives you the total cost of this whole loan, but there's an actual itemized list for it on the second page, which we'll go over in a minute. And then the cash to close is how much you would have to bring into closing. Once we fund the loan, you'll have to bring in a certain amount where you have an option to roll in all the costs into the loan. You can bring it to the table at closing and not roll it in. It's totally up to you how to approach this. Then we're moving along to the second page where everything is itemized for you. So it gives you a breakdown of what this $9,000 of cost, I guess, comes up to be. And it tells you the closing cost details. When you review this, I would always look on the right side and, on the left side and right side of things, because it's split up to two different sections. And the main reason for that is because the left section is truly what you're going to see some variations out there from lender to lender, and on the right side will not matter which lender you go with. These are actual costs, not fees. They're just a cost to do the loan, which we'll get in a little deeper explanation in a minute about those. So again, the left side truly shows you what you are paying to get this loan, or what third-party fees are involved with getting this loan. In the section A, in the first section, you'll see any points that you have, that you may have to buy down the rate. Some loans come with points, some rates. Actually, all rates are attached to a dollar amount. So some rates can come with points, and some rates come with lender credit. That's where you would see it right here in section J, the lender credit, if there are any, instead of the points. In this example, you can see how much you're buying down the rate to get to that 2.875. And then it shows you an underwriting fee of $1,095 with the lender, and then right below that you'll have line B, which are call it junk fees, which most lenders charge for credit report, flood certification, and tax service fees. And of course, the appraisal fee. Most appraisal fees are collected up front to start the process. If we do not need an appraisal, then you'll have this item will not even be here. So just depending on the deal itself, we can find out if we can waive the appraisal once we create a new application and structure the loan, and then we can run it against Fannie Mae and Freddie Mac, which will allow us to know if we need to order an appraisal or not. So again, line A is just what the lender actually charges to buy down the rate or any underwriting fees. Line B is small junk fees that are involved with the transaction. Line C are your title and escrow fees. Every time you refinance or purchase a home, there's always going to be a title insurance that needs to be drawn to make sure the title is free and clear on your home. There are no liens on it, and an escrow fee where this escrow company basically wires all the funds from all parties, of all the parties involved in the transaction, the old lender, the new lender, the broker, if broker involved, the borrower. So that's this fee covers these transactions for you. And then line D as in David just totals everything on the left side. Line A, B plus C comes out to a total. Excuse me. So this is how you can go ahead and compare the third party fees between lenders. And then everything on the right side, as I said before, is going to be standard fees. They may show higher or lower from different lenders when you're comparing to. But when it comes down to the finish line, all these items will get itemized and updated to what they're supposed to be. No matter which lender you go with. Recording in line E, you'll see a recording fee with the county. This is an overestimated amount for compliance purposes, and it gets adjusted lower according to that county. Line F is your prepaid interest, because every time you refinance or purchase a home, you have to prepay your interest for the remaining of the month, and that is why you're going to skip the following month of payment, and you'll have a payment after that. Meaning, for example, if you close a loan in October, you are going to skip your November payment, and your first payment will start only in December because you're prepaying your interest here. And then line G is your escrow collection, your initial escrow payment at closing. This every time if you want to continue making your taxes and insurance payments with your mortgage, would have to create I call it a piggy bank account where taxes and insurance are being collected every month. And the account grows until insurance or taxes are due, and then it gets dispersed from that account. Line G, most of the time, it gets really close to what you actually have in your existing escrow account with your current lender. So in this example, we're collecting about $4,200, and your escrow account should show now about $4,200 as well. So usually this ends up being a wash. Then line H is usually 0. Line I is just the total of the right side of things, and then that gives you line J the total, and below that it shows you if there are any lender credits from this rate. Then calculating cash to close shows you the loan amount minus the closing cost, and then estimated total payoffs. The payoff is based on what is shown excuse me, what is shown on your credit report. So this amount will change as well by the time we close, because we're going to collect, or we're going to order a payoff demand from the existing lender to make sure we're paying off the correct amount, where your existing lender will collect some prepaid interest as well. And then on the bottom of that, you'll see estimated cash to close, and it'll show you if it's from you or to you at closing. Then on the third page, I'm sorry, but this is a summary of the closing cost details. These first two pages are truly the juice of the loan and knowing what you're getting. On the third page, it just gives you calculations of how much you'd pay in principal over the next 5 years, how much you'd pay principal and interest in the next 5 years. We'll show you what is the amount of interest, what is the percentage of the loan that will be paid as interest, meaning the total amount of interest that you'll pay over the loan term as a percentage of your loan amount. And then, of course, the APR, annual percentage rate, which is APR does not negate what your monthly payment is. It's just the calculation of your interest rate and adds on the closing costs into that equation and equals a rate out of that. So it just takes the $9,000 minus the escrows, and being reflected as a rate, but it is not what your monthly payments will depend on. And then you have some other considerations on the bottom of here if you're planning to service or transfer the servicing of your loan, which you're refinance in the future, if you can assume the loan or not, and so on. So you can always review that, and it's pretty straightforward across the board. Thank you so much for taking the time and going over the loan estimate with us. If you have any questions, feel free to contact me, Sean at lendevity.com, or you can call or email directly to the loan officer that has been helping you. Thank you so much. Have a great day.